Hi there, everyone. Welcome to another week's episode of Capital and Context with myself, Mark Insley, and Samuel Hallett.
Good morning.
We're separated this week, so missing you, Sam. But yeah, set to want to keep the consistency going on the podcast. This week's episode, we're going to keep very UK focused. Lots has been going on in our local market, and as much as we invest globally around the world and like to try to reflect that in our podcasts. We are going to keep quite UK heavy and focused today, if that's all right with you this week, Sam.
I'm pretty sure I can manage that. Can you manage that being out of the UK?
Ironically, but yes, hopefully we're well prepped and ready for another exciting episode. Um, Firstly, I guess let's talk about what's been going on this week in the UK. Do you want to sort of touch on the local elections and other things first, and then we can go on to sort of talking more broadly about markets and bonds.
Yeah. So just to make clear that today we're recording on Thursday, the 14th of May. So last Thursday was the local elections in certain parts of the UK. Key thing there is not every council had an election, as Mark unfortunately found out when he went to go and vote. But so we ended up as expected, well expected. Labour got absolutely annihilated. What was quite interesting coming out of that is actually that bond markets were a little bit up, like the gilt markets were a little bit up on Friday, which surprised me a little bit. No, it didn't surprise. So down a little bit on yield on Friday, which kind of caught me by surprise a little bit. But this week, that narrative's very much reversed, and gilts have been selling off. Sterling has been down a little bit, not hugely. I think what's been keeping it up is that it's actually quite hard to remove a Labour leader by force. You need 20% of sitting MPs to back an alternative candidate. So it's not just, with the Conservative Party, it's a case of a movement of no confidence in a sitting leader, whereas with Labour, it's more, look, we've got an alternative leader that we want to put forward. So you can't just remove a sitting leader. So there hasn't anyone who's formally put their name in the hat yet, but today it's probably either going to be Mr. Streening or Angela Rayner put their names into the hat, at which point I would definitely expect movement in the gilts and the FX markets.
Okay. And any sort of, what was the biggest reaffirmation you took from those local elections, and what was potentially any element of surprise?
I think the thing that caught me a little bit by surprise was, don't get me wrong, like everyone was expecting Reform to do extremely well out of this, but what surprised me was there was still several areas where they really, really struggled, and in some places where parties like the Lib Dems actually came out stronger than they went in, and it wasn't necessarily a whitewash. So I think some people are taking a little bit of the markets, a little bit of calmness within that. Um, the first past the post system in the UK with our constituencies means that, you know, little geographies, differences in geography and cultures within those matter. But I think within the wider trend, I think it reaffirmed our scenario planning, really. We're going to probably end up with a change of Labour leads at some point in the next 3 to 4 months. And then we'll probably end up with a little bit of calm, hopefully, in the UK for a little while. And then obviously we go into 2027. Sorry, 2029 is when the general election has to be held by. And at which point, I think, again, we end up with a little bit of political noise again in UK markets.
I guess sort of thinking ahead to elections again in general elections in a few years' time. we obviously are in a very new world of a breakaway from the two traditional sort of parties really sort of being the only choices. Do you sort of see that now as a tri-party or even more than a tri-party sort of system that we're left with in the UK? Like how many parties do you think realistically could be put forward as candidates for the next?
Well, let's not forget that when you marked your ballot paper, sorry, excuse me, paper, um, there was always more than Conservative, Labour, and Lib Dems. You always had the more fringe parties on there. Obviously, Greens have always, at least in my lifetime, always existed on that ballot paper. Could also argue the Monster Raving Looning Party as well, but you always had a good spread. Yeah, yeah, exactly. Yeah. I think realistically, you're going to end up with probably four um, groups, UK wide, so to speak. Obviously, you're going to have the nationalist groups in Wales and Northern Ireland and Scotland. But you're going to end up with probably Labour. Conservatives, I think, will probably make in a few years a little bit of a comeback. It's just I think they're really struggling to work out what their messaging is at the moment and how to differentiate themselves. Lib Dems will still have really strong voting bases in say like Richmond area, and also in the southwest of England, really strong voting bases. Obviously, going to have Reform and there's one other that's going through my mind. Mark, you might remember off the top of your head. Sorry, not Reform. It is Restore. Restore, sorry, yeah, and Restore. So you've got those, and also of course the Greens, which I think Greens will come in and out of fashion. I think it's at the moment it's a little bit of a fashionable vote amongst young people, but I don't think that will necessarily stay over the longer course. You see this quite often, don't you? You think back to the 2010 general election, how Nick Clegg came. I'm not going to say out from nowhere, but his party popularity soared, and now the number of Lib Dem MPs is very small indeed. So, I think the Green Party is going to go through a little bit of that same kind of story, a bit of a blip. Possibly. I think you're right. In some ways, I think you might end up with a stronger government out of that. If you've got a large supergroup, so to speak, that very much agree on a large set of fundamental elements, I think you end up with quite a lot of stability within Parliament. Obviously, 2010 to 2015, we had the Conservative Lib Dem government in place. It was actually quite a stable period in politics in recent years. So it'd be interesting to see what comes out of that in the future. But yeah, I think people are going to have to learn to negotiate, which I'm not sure Nigel Farage is ready for on that one.
Sure. To UK equities then. Let's start there. FTSE, I think, is up 5.5% year to date. I think the S&P up a bit more than that in sterling terms. Again, you could say the US is having another year where it's ahead again. Does that backdrop change how you think about the UK versus global equity positioning?
So, first thing to bear in mind is, of course, that UK in market cap terms is now a single digit percentage of the global equity index. So, UK investors, by and large, even at the much smaller percentages that they have now compared to historically, even at say 15% holding within your portfolio, you are overweight the global benchmark. I think UK has been helped to a degree. It's very much a large part of it is resources orientated, and obviously what's been going on in the Strait of Hormuz is pushing all of those primary industry output prices up, which is obviously going to be beneficial for their returns. But uh, you know, there's that sector of the S&P 500 that people love to continue betting against, not necessarily us, that continues to perform well, and that's the AI trade. AI has been reporting really, really good earnings numbers of certain parts of it, and all of that capex worries is converting it into good revenue. So I think I don't necessarily think there's been a big change in the UK versus the rest of the world narrative over the last few months.
Of this week's episode on, quite specifically the UK economy. Either, and you don't have to necessarily say where you are positioned or anything like that, but in terms of like having a view, positive or negative, on the UK economy as a whole, how do you actually go about making that a feature, making sure that's actually reflective of an opinion on the UK economy in portfolio?
Yeah, so typically that's going to be if we're just doing passives, then that's going to be a FTSE 250 play. So if you watched our podcast last week, so that's the 250 largest companies by market capitalization after the FTSE 100. Those companies tend to be a lot more domestically orientated than the FTSE 100. It tends to be a bit more global. It's about 80% of revenues in the FTSE 100 are not denominated in sterling. It's a bit, quite a bit different when it comes to the FTSE 250. I think when it comes to that FTSE 250 area, I think the thing that need to be cautious of is consumer sentiment. I think has been holding up quite well so far. I think when we go into winter might be a little bit different. We're going to end up with obviously higher gas and electricity prices going into obviously winter period when we're more reliant on gas and electricity as a function for, I'm not going to say, well, yeah, as a function of survival, really. I think we're going to end up discretionary spending is going to be hit quite a bit in the UK in the latter half of the year. That said, I think industrial spending has been doing okay. I think we've gone past the worst of it. People have to spend, as in companies have to spend money at some point. We can't keep on using Brexit as an excuse. Otherwise, no company would have ever spent any money on capital expenditure for 10 years now. So yeah, I think that narrative there is old news. I could disclose it, though it's very much let's put that out that this is a company view and it's not a recommendation for people listening in. We're broadly neutral, so we are more favouring the FTSE 100 over that 250. As I said, the FTSE 250 space is a little bit more uncertainty on, whereas the FTSE 100 we have a little bit more confidence on the direction that things are heading. This issue with primary industries, in terms of affected on the straightforward moves. I think it's going to benefit. People are underestimating how long the effects of that are going to last for, and I think that's going to benefit them for longer than the market realizes so far.
That sort of underweight sort of view on UK domestics, then I feel like we've been waiting. I think 2022, too much money was sort of flowing into sort of UK domestics, and certainly too much money flowing into VCTs, and that kind of UK domestic being probably like overvalued as ever. Great in hindsight, but yeah, we're probably like 4 years.
I think you're going to have to wait roughly 12 months to see that. I think you're going to have to see how inflation feeds through. And I think the reason for that is because it's going to really affect the Bank of England and, whether they, the rate cut narrative. If rate cuts start to feed through back again, as they were, I think, again, that's going to really help consumer sentiment, going back to that really important thing that I mentioned there, as well as it's going to feed through on a technical valuation perspective. So I think that's really good. As I mentioned, that political clarity at the moment we're in a little bit of limbo where it's like the Starmer cabinet, it's the, well, apart from when they keep on resigning this week, the Starmer cabinet is still in place. But how weak is it? And you might get to a point fairly soon where people are offered cabinet positions and they just straight decline them. At which point, his leadership will just collapse. So we're in this point where the thing that markets hate is uncertainty. So we need political clarity of what's going on here, and that will keep a lid on domestically exposed names, really, and that's quite important.
Okay. Moving on to UK gilts. I think I was pushing you on this, and yeah, some of the CBAM research team provided me with some good insights. So yeah, sort of with gilt sort of being back above 5%, where does the gilt market go from here? And yeah, if we can just explain the differences for viewers in yields on the kind of short end of that versus the long end, which I know has sort of been hurt more the last few months.
Yeah, so within our portfolios, again, not a recommendation, just as a stating our positioning, we're kind of more focused on the shorter end of the curve at the moment. There's two major reasons for that. One is again that political noise, and point two is that, well, actually it's threefold. One is the UK issuance of gilts is at a rate that the market is struggling to absorb, and it's the plan is to continue that up pace for another 2 years. So the longer end of the curve is coming under quite a lot of pressure there. So that's yields going up, current values going down. The other problem as well, which is more problem in UK has had now for some time, but it's going to continue, unfortunately. And as our current account deficit means that we're very much, so that is basically the value of materials that we send out to the world versus the basically the amount of capital that comes back into the UK. We're in deficit there, so the world is buying less of our goods than we're buying off of them. That doesn't help sterling, doesn't help gilts either. So the drill narrative that's going on, down the more righter ends of the political spectrum does have actually quite a lot of benefits when it comes to that sterling and gilts conversation. Where things go from here, removal of that political uncertainty will make a big difference on gilts. The problem is those who replaces them. If it's another soft left candidate, we'll get a pullback on yield, so gilts will rally. But the problem is, though, I think it's quite likely that we're going to end up with a prime minister who the markets aren't going to like, and that's going to push the further ends of the curve to losses. Whereas, to be honest, the reason why we like the shorter end of the curve is that's more defined by the Bank of England, and not just that, it's less sensitive to yield changes on values. So we tend to, hold our value there better in a sell-off situation. So it obviously, as a multi-asset portfolio manager, we're never going to completely get rid of gilts. It would just not be prudent for ourselves to do so as UK-based model portfolio managers.
Nice thing about virtual podcasts is I can have a little look at things also. So reaffirmation of position, overweight, short duration gilts, sort of anywhere between 2 to 3%. Is that where you're sat at the minute in the?
Yeah, that sounds correct. I think the thing that's interesting that we're underweight at the moment, which might seem counterintuitive considering we're talking about inflation quite a bit, is index-linked gilts. And the reason for that is because index-linked gilts, due to the function of how they're priced, are actually really sensitive on yield changes. And so as things have been selling off recently, they would have been hammered. There's no other way about it. They would have been hammered in terms of their capital losses recently. So we don't actually hold those in the P portfolios at the moment. And I think that's been a benefit. There will be a time when we bring those back in, but as I've spoken previously, we're preferring US inflation-linked bonds at the moment, and actually they've worked quite well.
Yeah. And corporates, please. You haven't touched on corporates to kind of just finish this UK focused piece off.
Yeah, so UK, although we're slightly underweight, that's not necessarily a product of us thinking the space isn't healthy. As a matter of fact, it seems like an area I might be bringing back into. There's some very good yields on offer there. You're looking at, with the 10-year gilt now cycling around 5.5%, you're picking up low 6% yield there now on some very strong, healthy balance sheets. Why wouldn't you want to? It's a shame that our MPS, that as a function of how of the platforms we operate on, we can't buy individual individual bonds, because I would love to buy some individual holders and just keep them on there for the duration of them, just lock in that 6% for the next 7 years to just sit on the portfolio.
Okay. Okay. Um, and maybe I'm conscious on time, but I watched an interesting documentary slash film called The Great Hack. I don't know if you've seen that.
No, that's a new one on me.
Maybe you'll have to watch it, and then we can do a podcast episode on how we think things like that affect financial markets. Yeah, we'll do that. I watched an interesting documentary on the how that there's been a lot of cases and protections added since, but just how much the scraping of data, the Cambridge Analytica, it was all based on Cambridge
Oh, yes.
Analytica. And obviously, yeah, just started off with the sort of chat on the elections and rhetoric and things. And yeah, watch it and we'll discuss it in another episode around how you think things like that affect markets, not just, electoral results, but obviously those electoral results are so determinant on what has happened, and it was interesting. So yeah, it'd be potentially good one just to run an episode on, to kind of almost be like, have some of those fears gone away now, obviously with Cambridge Analytica going into bankruptcy, or as it just moved on to other ways and means and things. But we'll save that for another.
Does that mean that I have to mark this episode down? What do you mean? I've been helping improve our infrastructure, develop so much quicker at the weekends. I haven't got time for that at the moment.
Thanks a lot there. Obviously, yeah, with everything that's gone on in the UK, I wanted to keep this focused there. So yeah, again, thanks for your time as ever. Thanks to Jay and Issa for their efforts on the editing and keeping these episodes consistent. And yeah, see you guys next week.
Bye.
Bye.
Thanks. Bye.